Hi there. Today we will learn how to mind map IAS 33. Earnings per share. Before going further, let's understand IAS 33. Earnings per share. As per IAS 33, earnings are profits available for ordinary shareholders. Earnings per share, EPS, is a measure of the amount of earnings in the financial period for each equity share. EPS is calculated as reported earnings, adjusted for a few things, and divided by the weighted average number of ordinary shares on that year. IAS 33 specifies the profit figure that should be used and explains how to calculate the appropriate number of shares when there have been changes in share capital during the period under review, and also describes the concept in dilution, which is caused by the existence of potential ordinary shares. Accounting treatment for IAS 33 earnings per share. Basic earnings per share. Basic EPS is calculated by dividing the profit or loss, that is total earnings, on continuing operations by the weighted average number of ordinary shares in issue during the period. IAS 33 gives guidance on total earnings and weighted average number of shares. Total earnings. It is the profit, loss from the continuing operations after deducting tax and preference dividend. In case of consolidated financial statement, after excluding the earnings attributed to non-controlling interest. Total earnings include any income from associates. Where there is a net loss, total earnings and EPS are negative. Total earnings must be adjusted for preference share, cumulative preference shares, increasing rate preference share, early conversion of preference share, repurchase of preference share, preference share. Preference shares must be classified as equity or liability. If treated as equity, any dividend relating to the share is recognized in equity. Any dividend must be deducted from profit, loss from continuing operations. If treated as liability, that is redeemable preference share, any dividend relating to that share is recognized as a finance cost in profit, loss. As it is already deducted from the profit, loss from continuing operations and no further adjustment needs to be made. Cumulative preference shares. Where a company fails to declare a preference dividend in a period, in case of cumulative preference shares, the holders are entitled to receive the missed dividend sometimes in future. The dividend accumulates when not declared. If there are cumulative preference shares in issue, the dividend must be deducted from profit, loss from continuing operations, regardless of whether the dividend has been declared or not. For non-cumulative, the dividend would have been deducted only in case of declaration. Increasing rate preference share. The amount that arises on discounting the proceeds that will be received in future are amortized using the interest rate and treated as preference dividend for calculation of EPS. Other elements such as transaction cost may also be amortized. Early conversion of preference share. Where there is early conversion of convertible preference share, the excess amount transferred is treated as a return to preference shareholders and must be deducted for EPS calculation. Repurchase of preference share. Where the fair value of the consideration paid to preference shareholders exceeds the carrying value of the preference share repurchased, the excess is a return to the preference shareholders and must be deducted from the profit. Where the carrying value of preference share repurchased exceeds the fair value of consideration paid, the excess is added in profit. Where preference shares are treated as liabilities, no adjustment is needed. Weighted average number of shares. There are different ways in which the number of share may change. Issue for full consideration. Issued for no consideration. Right issue. Examples include bonus shares, share splits, reverse share splits, bonus elements in other issue. Weighted average number of shares must be adjusted for issue at the full market price. Partly paid shares. Rights issue of shares. Issue at the full market price. These are included from the date of issue. Partly paid shares. The number of ordinary shares is calculated based on the number of fully paid shares. The partly paid shares are included as an equivalent number of fully paid shares to the extent they are entitled to participation in dividends. Bonus issue of shares are the new shares issued free of charge to existing shareholders, often by converting equity reserves, that is share premium account, into ordinary share capital. No cash is raised, therefore no earnings boost from the issue. The new number of shares is found by multiplying the number of shares before the bonus issue by the bonus issue fraction. Bonus issue are treated as if they always been in issue. Therefore multiply every issue before bonus issue with bonus fraction. For comparative figures, it would be misleading, as there are no earnings boost due to bonus issue. Therefore, previous year's EPS is restated by multiplying it with inverse of bonus fraction. Rights issue of shares. It is an issue of new shares for cash, where the issue price is always below the current market price. This means that they include the bonus element which must be taken into account for calculation of weighted average number of shares. Just like bonus issue, any comparative figure must be restated by multiplying previous year's EPS by inverse of the right issue bonus fraction, that is actual cum right price divided by theoretical X right price. Actual cum right price is the market price before the right issue. Theoretical X rights is the price entity issued that shares. Thanks for watching. More stuff coming soon.